Did you know a single news event can move the Forex market by over 100 pips in just seconds? That event is the Non-Farm Payrolls, also known as NFP. It's one of the most powerful and dangerous times to trade in Forex. In this video, I'll break down exactly what NFP is, why it matters so much, and step-by-step strategies you can use to trade it safely and profitably. Welcome back to the channel. If you're new, I help traders understand the markets in a simple way. Today's topic is the NFP, the Non-Farm Payroll Report. This report comes out once a month, usually on the first Friday, at 8:30 a.m. New York time. It measures the number of jobs added or lost in the United States, excluding farming, government, and military jobs. Why is this important? Because jobs tell us how strong the U.S. economy is, and when the U.S. economy moves, the U.S. dollar moves. And when the dollar moves, almost every Forex pair reacts. NFP is considered one of the most high-impact news events in Forex. A strong jobs number usually strengthens the US dollar because it shows the economy is doing well, businesses are hiring and consumers are spending. On the other hand, a weak NFP weakens the dollar because it suggests economic slowdown. Traders pay close attention to this because it directly affects the Federal Reserve's decisions on interest rates, inflation, and monetary policy. That's why you'll see huge volatility in pairs like EUR-USD, GBP-USD, USD-JPY, and even in gold and stock indices like the Dow Jones and S&P 500. So how do you actually prepare for this high-impact event? Your preparation is everything. First, you must consult an economic calendar. Free sites like Forex Factory or investing.com are essential. They show you the release time, but more importantly, the market's expectations. You'll find the forecast number, which is the benchmark, the previous number for context, and then the actual number when it drops. The market's reaction hinges on how much the actual number deviates from the forecast. A big surprise equals a big move. Also, look for related data like the unemployment rate, as it can create even more volatility. Second, become an architect of your charts by marking key support and resistance levels. These are the psychological battlegrounds where price will react. For example, if EUR-USD has been bouncing between 1.0900 and 1.1000, those are your immediate zones, but don't stop there. Zoom out to the daily or weekly charts to find more significant long-term levels. These higher timeframe zones act as powerful magnets during the NFP chaos, either causing a sharp reversal or fueling a massive breakout. Having them marked is critical. Third, and this is non-negotiable, decide your strategy in advance. Will you trade the initial spike? It's a high-risk play with wide spreads and slippage. A more conservative approach is to wait for the retracement that often follows the first move, offering a better entry. Or the safest path, wait 30 minutes for the dust to settle, and then trade the newly established trend. The worst thing you can do is open your platform without a plan. Letting emotions take over is a recipe for disaster. Strategy 1. Wait for the spike. This is my personal favorite, prioritizing safety over speed. When the news drops at 8:30 a.m., the market explodes. Many beginners, driven by FOMO, jump in immediately. This is a classic mistake. In these first moments, brokers widen spreads dramatically, meaning your entry price is far worse than you expect. Add in slippage where your order gets filled at a completely different price, and you have a recipe for disaster. Accounts get blown this way. Instead, the professional approach is patience. Wait for 5 to 15 minutes. Let the amateurs and algorithms fight it out. Your job is to watch for a high probability setup. After the initial spike, price often pulls back to a key technical level, like a 50% Fibonacci retracement, a previous support zone, or a moving average. Once price tests this level and shows a sign of rejection, like a pin bar, that's your signal. You then enter in the direction of the main move. This is safer because you're trading with confirmation, not gambling on the first candle. Strategy 2, the straddle strategy. This method captures the explosive move without predicting its direction. Before the news, identify a clear pre-NFP consolidation range, then place 2 pending orders, a buy stop just above the range's resistance, and a sell stop just below its support. When NFP is released, the market will likely break strongly in one direction, triggering one of your orders. The best way to manage this is with a one cancels the other or OCO order, which automatically cancels your second pending order when the first is triggered. If your platform doesn't have OCO, you must be lightning fast and manually cancel the untriggered order yourself. But be careful, the biggest risk here is the whipsaw. This is when the market spikes up, triggers your buy stop, then violently reverses and spikes down, hitting your stop loss before triggering your sell stop. It's a brutal scenario that can cause 2 quick losses. Risk management is absolutely key. Your stop losses must be placed carefully, wide enough to absorb the initial volatility, but still respecting your risk per trade. This strategy requires precise execution and a stomach for high-risk scenarios. Strategy 3. Post-NFP trend trade. If you're a day trader who dislikes the chaos of the first few minutes, this strategy is for you. It's the patient trader's game, completely ignoring the initial frenzy. Instead, you wait for the dust to settle, typically for an hour or two. By then, the market has digested the news, extreme volatility has subsided, and a dominant intraday trend has often been established. This strategy is based on the idea that a significant NFP surprise can set the market's direction for the entire trading day. For example, if the report is much stronger than expected, say 300,000 jobs versus a 180,000 forecast, the USD might stay strong all day. On a pair like EUR-USD, this would cause a sharp initial drop. The trend trader ignores this. Instead, they wait for the 1-hour chart to confirm a new bearish trend. Then, throughout the day, they can look for low-risk entries to sell short on any pullbacks to new resistance levels or key moving averages. This allows you to ride the new dominant trend for potentially larger profits, all while avoiding the initial high-risk gamble. I can't stress this enough. NFP is high-risk, high-reward. If you're new to trading, don't start with a big lot size. Start on demo or with a very small position. Always use a stop loss and never risk more than 1–2% of your account on a single NFP trade. Remember, it's not about catching every pip, it's about protecting your capital so you can trade again tomorrow. The market will always give you another opportunity, but if you blow your account on one news event, your trading journey could end very quickly. So, let's bring it all together. The non-farm payroll report isn't just another date on the economic calendar, it's a heavyweight champion of market-moving news. This volatility is a double-edged sword. On one side, you have the potential for incredible profits in minutes. On the other, the risk of getting stopped out or experiencing severe slippage is equally high, catching unprepared traders off guard. Mastering NFP trading boils down to the 3 pillars we've discussed: preparation, patience, and discipline. Preparation means doing your homework, understanding market consensus, and identifying key levels to release. Patience means waiting for your specific setup, whether you're trading the initial spike or the retracement. And discipline? That's your non-negotiable rulebook. Sticking to your predefined stop loss, taking profits at your target, and never revenge trading. Ultimately, trading NFP isn't about gambling, it's about calculated risk-taking. Have a plan, manage your risk, and trade smart. If you got value from this deep dive into NFP trading and feel more confident, show your support by smashing that like button. Make sure you subscribe and ring the notification bell because we're breaking down other major news events just like this one. Now I want to turn it over to you. The trading community is all about sharing knowledge. What's your personal approach to NFP? Do you trade the initial spike or are you more conservative, preferring to wait for the dust to settle? Let me know your game plan in the comments below. I read every single one, and your experience could help another trader out.